Hi everyone, I'm Matt from Heron and welcome to the latest edition of the Heron Financial Podcast. Today, we're going to cover off some mortgage basics, and these are based on the frequently asked questions that we've had from you guys in the feedback and response to our videos. So we hope that this quickfire episode will give you some jargon busting and some ideas as to what these things are and what they mean and how they could affect your mortgage decision process. So the first thing I'm going to mention today is loan to value, or LTV. Now, if you've already started looking at mortgages and playing around with calculators online, you might have found this mentioned a few times and be wondering, well, what on earth is it? Well, essentially, it's the ratio of your mortgage to the value of the property that you're intending to buy or remortgage. So for instance, if you're buying a property at £100,000 and you're putting down a deposit of £25,000 with a mortgage of £75,000, then that loan to value would be 75%. You're essentially looking at a 75% mortgage. It goes without saying that the lower the loan to value, the better the interest rate. And in real terms, that means if you've got a big deposit, you'll get a cheaper mortgage. The next thing we're going to talk about is the mortgage term. Now, the mortgage term is the overall length of the mortgage. Now, traditionally, again, if you've been online and looked at calculators or even spoken to your bank, that would normally be put in as 25 years as a default. The truth is, you can make that term any real variation up to around about 40 years, where some lenders draw the line. So the term can be used to control the monthly payment. The longer the term, the lower the monthly payment. But please bear in mind, if you do go for a long term, something like 40 years, then over time, you would be paying back more interest because you're spreading those payments over a longer period. The mortgage term is something that you can use to your advantage if you want to bring that payment down, but always bear in mind that the interest is the flip side, and you need to consider that trade-off when you are making those decisions. The next thing that you might want to consider when you are looking at mortgages is the product or deal period. Now, you may have seen this advertised if you're walking down your local high street and you can see one of the banks that's still left. They could have 2-year fixed rate, 3-year fixed rate, 5-year fixed rate. This is the length of time that you have your initial product for. It's not to be confused with the overall mortgage term. The product period is the only period of time that you actually know what that monthly payment will look like, providing it's a fixed rate, which we'll come on to. But it's really important that you select a product period or a deal period that works for your life and your circumstances. So if you know that there's a good chance that you could be moving home again in 2 years' time, it may not be the most sensible choice to pick a fixed rate for 5 years that then could potentially restrict your options. Talk to an advisor and get some real advice tailored for you to make sure that the product that you pick is correct for your circumstance and your life. The next thing that I'm going to hopefully clear up for you is a fixed rate and a tracker. Now, what do they mean? One of them sounds quite obvious. A fixed rate is exactly what it says on the tin. You get to fix your product for a period of time that you decide. Coming back to the previous point on 2, 3, or 5 years, that's ordinarily the time choices that you have. You know that if you have a fixed rate for 2 years, it doesn't matter what's going on in the world with interest rates and anything else in the economy that could potentially affect your mortgage. Your product is fixed for that period of time. A tracker rate works differently, and generally it would track the Bank of England base rate, which is open to moving around. And over the past few months and years, we've seen quite a few of these movements. Be aware that with a tracker rate, if the base rate moves up, your mortgage rate moves up with it, and therefore your payment could increase month by month. Similarly, if the base rate comes down, your mortgage can potentially move with it and your payment could come down. So the tracker brings with it risks, but often could bring flexibility. As always, go and get some advice. Talk to a broker or a mortgage advisor who can help you make the right decision on whether you need to look at a fixed, a tracker, or any other numbers in between. The final point is not really a jargon buster, but it's more of a start point if you've watched this episode and found the previous information useful. Your monthly budget is where you should start. Rather than going online and looking at the property that you think is the one that you want to live in, work backwards. Have a conversation with the other person that might be involved in the mortgage, or if it's just you, sit down with a pen and a pad and work out what do you want to spend each month on this new mortgage. That can be your start point, and all of the things that I've just explained and discussed could potentially be tailored to come in line with that budget. It's really important that when you move into this new home, you aren't going to be faced with a situation that all of a sudden you can't go out and live your life. So make sure that the budget is always the start point to establish your own affordability, irrespective of what that property might cost or what a bank might be willing to lend you. These are just a few of the things that you might want to consider when you are looking at applying for a mortgage. There are so many more, and I would always encourage you to go and seek out some advice, talk to an experienced advisor or broker who can help walk you through that process in a way that's tailored for you. I hope that you found today's episode useful, and we look forward to seeing you and hearing from you on all of our channels: YouTube, Spotify, Google Podcasts, Apple Podcasts, and many more. Please remember to like and subscribe and send us your feedback. We're really grateful for you to continue watching and listening, and we look forward to seeing you and hearing from you on the next episode. If you have any questions or you want any more detail on some of the subjects and topics that I've covered today, please do give us a call, drop us an email, get in touch, and we can arrange an appointment where you can get some expert advice.